But really quick,
Yeah.
the one says, my employer only offers FSA. Are there other ways to get on an HSA than through an employer?
Absolutely, there are such a good question. And the FSA is that it commonly gets mixed up with the HSA. The FSA is use it or lose it, but the HSA is yours for life. You pass away, it goes to your spouse if you're married, if not, distributed as income to your heirs. With the HSA, here's the kicker. With the 401k, your employer has to offer it to you in order for you to be eligible to make contributions. However, with the HSA, the kicker is you need a qualifying high deductible health insurance plan. You don't have to be employed. If you retire at 55 and you're living your best life, well, from 55 to 65, most people are going to go shop on the marketplace, Obamacare or the Affordable Care Act, and oftentimes they're going to be on a high deductible health insurance plan if they're relatively healthy. They may not be working in those years, but because they have a qualifying high deductible health insurance plan, they are eligible to open up an HSA on their own with whatever financial institution they want, make contributions from their bank account, and they still get the tax benefit come year end on their 1040 tax return for those contributions that they make to an HSA. They can invest it the same way. If you've got old HSAs from other employers, you can consolidate them into one HSA. In fact, if you have an HSA and your employer's firm that they've contracted with, you don't like the investment options, the fees are high, or maybe they require you to keep something like $1,000 or $2,000 in cash, which by the way is not law. That's just the financial institution trying to make a buck off you. If they do that to you, you don't have to leave it there. You can, once a year or something, roll that over to your own HSA at a financial institution you prefer that doesn't have those restrictions, that has great investment options and low fees. Keep that one open because that's where your employer may be contributing money and that's where you're going to do it through payroll, but you can do that whenever you want. You don't have to leave your employer. So, was there one more question, Michael, or is that on the HSAs? Okay, we're going to keep rocking and rolling it. Oh, we got one more?
This is not HSA, but just real quick. If you want to do this now or later, it's fine.
Fire away,
Is,
fire away.
is there is there a place for gold and physical precious metals in your portfolio?
There might be a small place for a limited amount of time depending on your situation, but when you compare precious metals to the host of other investment options out there, they pale in comparison. They can be good temporary hedges against inflation at very specific periods of time, but I'll tell you, for most do-it-yourself investors, they buy gold, they store it under the mattress or in a safe or wherever, and it just doesn't perform at the same pace as U.S. Treasuries, as bonds, stocks, real estate, the host of other options out there. Okay, so the HSA, we talked about that. Let's speak to the Roth IRA for a minute. With a Roth IRA, contributions that you make to a Roth go in after tax, just like money that you put in your bank account goes in after tax. And so you could transfer money from your bank to your Roth, that's fine. And then the money grows tax-free from there on out. Contributions this year are limited to $7,000 and $8,000 if you're more mature and over the age of 50. If one of you works and you're married, your spouse is staying at home or doing something else, your spouse can also make a spousal contribution. There are income limits associated with Roth IRAs. And so if you make above a certain amount, you're no longer eligible to go through the front door or just to make a direct contribution like I've described. But there is a backdoor method that a number of you asked questions about prior to this. And that's essentially a tax loophole that you can take advantage of. Yes, so just know that that's an option. And I know it sounds sketchy. I'm not sure who came up with the backdoor Roth. That's the name of this strategy. But don't be confused. It's not like some Cayman Island offshore trust fund that is illegal. It's very black and white. The IRS has recognized and acknowledged it many times, but it sounds cool, right? Next up, number 5, increase your contributions to a 401k or a Roth 401k. Okay, so here's, at the end of the day, we can boil this decision down very simply and say, do we want to get a tax deduction today and kick it down the road and potentially pay a higher or lower tax in the future? Most Americans that are saving in retirement plans today are making pre-tax contributions, reducing their taxable income today, and then in retirement, their hope is that they'll be in a lower income because they're no longer working, and now they'll be paying a lower tax rate as well. There's a big assumption there that tax law never changes. It certainly does. Now listen, I recognize I'm a little bit nerdy. I'm a CPA. In addition, I'm a financial advisor first, but previous life, I worked for a big four accounting firm. And I will tell you, tax law evolves enormously. And we'll see what happens in November. There's a chance that, if the House and the Senate and the White House go Democrat or Republican, we could see some big changes in how taxes look. But let's assume nothing changes. At the end of 2025, the Tax Cuts and Jobs Act will sunset, meaning that for most Americans, the high standard deduction that they've been enjoying for the last couple of years will be lowered, and their tax rates will be increasing. For example, if you're in the 22% tax bracket today, assuming Congress doesn't change a thing, come 2026, you'll be in the 25% bracket. If you're in the 24% bracket today, you'll be in the 28%. And that can add up. Just a couple percentage adds up on the federal side. So something to consider when you're making contributions today. We're in a historically low tax rate environment right now. You look at history, the last 5-6 decades, it's almost never been lower than it is right now. Many individuals are either making Roth contributions today so that they can lock in their tax rate, where they know exactly what it is, and now they don't have to worry because the money within the Roth is growing tax-free into the future. Alternatively, many individuals who already have a decent chunk of retirement savings in their IRAs, 401ks, or other retirement plans are deciding to do a Roth conversion. A Roth contribution is adding new money to a retirement account. On the other hand, a Roth conversion is changing the nature of pre-existing retirement dollars to Roth. Now, when you do that, that's a taxable event. That's going to generate ordinary income. But by being thoughtful, and right now, this time of year is when we're doing it, because by now we have a pretty good idea of what your income is, and we can strategically fill up specific tax buckets or brackets. I like to think of them as buckets. And we want to be thoughtful about when we do that and how we do that. But I'll tell you right now, it's probably one of the most popular strategies for individuals who have a decent amount saved up in pre-tax, or just people who want more Roth money. So something to consider. But at the end of the day, increasing your contributions to a 401k can be great if you're looking to save for retirement. Michael, fire away.
Real quick, just a couple of Roth related questions. I'm going to do two of them for you. If you start with a Roth IRA, then hit over the salary limit, what would you recommend as far as moving the retirement plan into, something else? And then somewhat related, if you make, say, $100,000 a year, how do you know if you will make more or less than that in retirement? Example, Roth IRA contribution versus 401k contribution now.
Okay, there's a lot to unpack there, but I'm going to try and simply attack this. Remind me what the first question was, Michael. If your salary increases above the limit?
Yes.
Okay.
Correct. What would you potentially move that into later on in retirement?
Yes, I understand now. With 401ks, there's no income limits. You can make Roth or pre-tax contributions regardless of your income. With IRAs, there's income limits for whatever reason. And so once your income breaks it, if you've already made the contribution, you go back and reverse that out, or recharacterize it is the word we use. But alternatively, you might want to consider a backdoor Roth to get money in, or look at some of the accounts I'm going to show you in a minute. And then the next question was income planning for retirement, if I remember correctly. How do you know how much you're going to have down the road? This is a financial planning question. And this is what a real financial advisor does. They will look at your situation, understand how much you have saved, how is it invested, what's the growth rate we can reasonably expect in the future, and they will start to model out different scenarios for you down the road. Based on those scenarios or this financial plan, we can now come back and say, what tweaks or what changes can we make today that will improve the success of our financial plan down the road in retirement? Now listen, at the end of the day, a financial plan's a guess. There's a lot of assumptions, there's a lot of unknowns, but there's a few things that we can do today to put yourself in a stronger position down the road. Diversification is a popular topic within the investment world, right? It's not keeping all your eggs in one basket. You understand it. But there is tax diversification that is equally, if not more so, impactful to your success in retirement. Just as you don't want to have everything invested in one company, it makes sense to not have everything invested just in a pre-tax or traditional IRA. This is why it's nice to have investments in different buckets. And there's really three big buckets we're looking at. There's the pre-tax retirement, There's the Roth or tax-free retirement, and I'm going to include the HSA in that bucket. And then we have a third bucket called after-tax or brokerage accounts. The brokerage account is next on the list here. This is an account that you can put as much money in as you want, and you can take it out whenever you want. From a tax perspective, it's almost the same thing as a checking or savings account. There's no limit. It doesn't matter if you're working, what your income is, you can put money in a brokerage account. The kicker is when you invest in a brokerage and it goes up, the investment, and then you sell it, you must pay tax on the increase, on the gain, the appreciation. And depending on how long you held that investment for, you could get favorable tax treatment. So if you hold on to investments for more than 1 year, the tax rate you pay is significantly lower than investments you've held on to for 1 year or less, which are taxed at ordinary income rates. The same rates, in fact, that you pay taxes on when you work. So ideally, more of your investments come from, I should say, more of your income comes from investments you've held on to for more than a year, because those are taxed at much lower rates. We call them capital gains rates. There's talk about those things going away in the future, but I'd be surprised if they went away. Now, a common question that's being discussed here recently prior to the election is Kamala has said she's going to tax unrealized gains. That won't impact you unless you have more than 100 million. If you do, give me a call. Number 7, invest in real estate. This can be a good place to also get diversification. It's not for everyone though. It comes with a lot of headaches sometimes. Number 8, contribute to your children's future. There's a number of accounts we can explore when saving for your kids. We have a 529, which is a college savings plan. You get benefits on the growth within the 529. There's been a few cool new laws that went into effect earlier this year in January that actually allow excess 529 money to be rolled over to your kid's Roth IRA down the road. You got to meet a few requirements with the timing on that. Pretty powerful stuff. But primarily 529s have historically been used for your children's education, and now brand new strategy is kind of a retirement planning tool if you want to save for your kids' future. But I'll tell you this, we have a saying in the personal finance world. Go with me now, we're 30,000 feet up in the air, right? And what do they say? In the case of, we lose oxygen, you put your own mask on first before you help your kid. It's the same way with personal finance. You want to be sure you're saving for your own future, for your own retirement. You've got a solid foundation in place before you help your kids' education. That's my 2 cents at least. The tax benefits are much greater in your own retirement plans than with a 529. There's some great tax benefits there, but they just pale in comparison. Another account you might consider saving for your kids is a UTMA account, or Uniform Transfer to Minors Act account. And it's essentially a trust account. You put money in when your kid turns 18 or 21, depending on where you live in most states, that becomes theirs. And then another account would just be a brokerage account like we've just described. The nice part about a brokerage account is you can control it and you can do with it whatever you want. With the UTMA, it's your kids when they reach the age of majority. And I know you think little Susie is wonderful and all, but she might meet that terrible boyfriend you don't like, and come 18 or 21, she might be making rough decisions. And if you don't want all that money going to little Susie, then maybe the UTMA is not the right fit for you. Something to consider. Number 9, invest in alternative assets. This is going to be kind of alongside real estate. And by the way, this isn't the end-all be-all. For many of you, we might move a few of these steps around. In fact, we might cross 1 or 2 of them off. But alternative assets would include things like private equity, venture capital, private credit, small business, crypto would be in the mix there. And then number 10, pay off low interest debt, like a low cost mortgage, for example. This is the order I would consider going through for a good chunk of you. Now, investing has its own language. I was surfing last summer in California. My in-laws live outside of Los Angeles. It was the first time I've ever been. I've been body surfing and boogie boarding, but I'll tell you, surfing was a whole new world. And I realized I had to ask questions of the guy I was with to kind of understand, the technique and the strategy. And with investing, it's the same way. So many detrimental mistakes can be avoided if you just spend a little time researching and you ask the right people. And sometimes the right people are professionals or people that are not financially incentivized by your decision. Okay, compound interest, right? No personal finance presentation under the sun, moon, or stars would be complete without something about compound interest. This graph just shows you, let's say you invest 100,000 today. And actually, we got a few questions that with this exact number. So you invest 100,000 today, and that investment generates an 8% return every year for 30 years. You don't add another penny to it. That's it, just the 100,000. At the end of 30 years, it's going to be just over $1 million. Your initial 100,000. That's because the dividends, the interest, the growth, assuming it's reinvested, is continuing to grow at 8%. Now, you and I know that it's not a flat 8% every single year when you invest. There's some years that are awesome. Like so far this year, we've been knocking it out of the park, more than 20%. And just the, if we look at just the S&P 500 as an example, the 500 biggest companies you can buy in the US. But some years is going to go down, right? A few years ago, things were bleak. And so this is just as an illustration. Okay, let me speak to this for a minute. What is investing and what is not investing? Okay, investing is, in my mind, a long-term strategy, investments you understand, and making sure that once you have a financial plan in place, then we talk about investments. But too often we're putting the cart before the horse on this, especially as financial advisors. You want to be sure that whatever it is you invest in makes sense for you, your goals, your tax situation, and then we go from there. And by the way, a 401k, an IRA, an HSA, they're not investments. They're accounts that you put money inside of, and once the money's in the account, then you invest. And it gets a special tax treatment. So just so we're speaking the same language. Investing is not putting your money in some life insurance product thinking it's going to solve all your problems. Even if it's your brother-in-law or a college roommate, okay, that's not investing. There's a place for life insurance, certainly. There's no question. And in rare cases, there's a place for permanent life insurance for very specific situations. But for the majority, term life insurance is the way to go. Investing is not, putting it all in crypto and hoping you'll have a good retirement. Yeah, there's people making money out there. It's ridiculous. But I will tell you that far and away, it's the simple, consistent strategies of building wealth that will get you to where you want to be. And one other word of caution. If you're spending all your time on cable news networks, you will make some of the worst financial and investment decisions of your life. I can't tell you the negative impact consuming news and other sources of media can have on your retirement decisions. At the end of the day, it doesn't really matter who gets elected. You look at history, if it's Democrats or if it's Republicans or whoever else, the market continues, and there's no evidence to suggest that one party in power over another will have a lasting impact on your success in retirement. So there's my 2 cents for you, a little timely message when it comes to investing. Don't get distracted. All right, let me give you an analogy. Like Michael mentioned, I love fly fishing. So at some fly shops, not all, I'm going to give many the benefit of the doubt, but sometimes when you go to fly shops or fishing shops, and I don't know how many of you have gone, but I go from time to time, there will be an excess supply or extra inventory. And maybe there's a bunch of flies on hand that somebody tied up. They're not useful, but maybe they attract the eye of the unexperienced fly fisherman or fly fisherwoman. And they may buy the investment because it's attractive, but it may actually not perform. Alternatively, there may be so much left over that they're just trying to push product out the door. Sometimes this is the case with bad players in the financial industry. So just be on the lookout for either people pushing products to you that you don't fully understand or you're not sure, how they're compensated. There's no such thing as a free lunch. So even if someone takes you out for a fancy dinner and they're telling you, oh, it's free to put your money in this annuity, at the end of the day, there's a catch. So just be sure you understand how they're compensated and who you're working with and what the trade-offs are there. There's always a cost with investing. Let me speak for a minute on 401ks, and Michael, I'll get to your question or the question that someone brought up. Within your 401k plan or other investment, there's a lineup of mutual funds typically. A mutual fund is a basket of investments piled together. The cost of that fund to keep it on an annual basis is described in a metric called the expense ratio. Write this down, put it in your phone. Expense ratio. It tells you how much you're spending in fees to own that investment every year. Every mutual fund has to disclose this by law in a prospectus. And so just make sure you're aware that whatever investments you choose, the fees or the costs of that investment are appropriate and you know what they are. Michael, fire away.
Okay, couple of questions, but also just a quick announcement to everyone or a reminder. We're getting a lot of questions, which is amazing. Rizik, we knew there'd be a bunch of them, so this is great. But if
We
you
did.
can, try to put them into the Q&A box, and we'll try to get to them in there. We're going to try as hard as possible. We're running short, I know. And then I see a couple of you that have your hands raised as well. If you have a question, try to go ahead and put those into the Q&A box. Rizik, just on while I have you, this is from earlier, but a couple of people have asked about SEP IRAs. Just kind of
Yes.
what your thoughts are there and all that kind of good stuff.
They're called SEP IRAs, and they're archaic and old school. Now, in rare instances, they make sense, but typically they're for small businesses. The solo 401k has come a very long way. And so if you're an employer or an owner of a business, I would say maybe it's time to consider a 401k. If you're self-employed, it's just you and a spouse, a solo 401k could be an option, or maybe a small business 401k. The costs, the administration headache in large measure has been reduced significantly, and you don't have the same headaches around looking at the profitability of the business to determine your limits for contributions. So I'll take one more. Michael, is there another one, or is that it?
Yes. Kind of just a general, how much of your portfolio should be in real estate? Is there a percentage or an
Good
area
question.
that you think is safe?
Yeah, it's a great question. Whatever you're comfortable with. I've got some clients that everything's in real estate, but you just got to recognize that if your plan for retirement is dependent on either rental income or more than likely you selling one or two of those properties, your timing for when you retire could be significantly influenced by where that property is located. And real estate is one of those unique asset classes that changes from geography to geography. And so if everything you own is in Texas or in Utah or in New York, those could be influenced not only by geographies, but also by tax and how favorable they think it is. For example, many people have fled California as landlords or rental property owners for a variety of reasons. The biggest ones are less favorable treatment from a state tax perspective and more favorable treatment towards tenants as opposed to the landlord. And a lot of money's flowing to the Midwest and the South. And so you just want to be kind of conscientious about what it is that you're investing in. Now, there's certainly opportunities in California, and I'm not telling you shouldn't invest there. This is all for educational purposes only. You already knew that. But just be cognizant. I would say that your primary residence, where you live, should have no bearing on your investment allocation. Unless your plan is to sell the home and downsize to get some cash to live on in retirement, or as a last resort option, maybe we do a reverse mortgage, but that would certainly be a very last resort, way down on the list. But otherwise, it's hard to get equity out of a property that you live in. So we're really just looking at invested assets like rental property or commercial property or something like that. So good question. All right, let's continue on here. Oh, the contrarian investment view. As human beings, when we see our friends, family members, coworkers making money and we check our 401k and it's going up, 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 which today it went up, it hit a new all-time high. If you didn't know, earlier this morning, it can be exciting, things are good, the cash flow is growing, right? It's sunshine and roses. And what people do, especially us as humans, it's only natural, is we think, you know what, now's the time, I should buy more and invest. But you're buying at the high. And then when things get tough and there's recessions or bear markets or whatever you want to call them, people get nervous, they hold on to cash, and they're less excited to check their 401k and IRA balances. And I understand that. It's not as exciting to see your savings go down in value. But if you can rewire your brain and see those drops as buying opportunities, it will be a wonderful wealth building tool for you long term, assuming you're invested in good assets. That's the contrarian view. When everything's up and people are excited and people are greedy, be fearful. And when people are fearful, that's maybe when you should be greedy. In the words of the Oracle of Omaha, Warren Buffett. Okay, the big dog is taxes. Just make sure that you understand whenever you put your money in an investment or in an account, there are tax implications. And you want to weigh different choices, always with tax in the back of your mind. I can't tell you how often people don't recognize the tax bite that's taken out of their retirement. Like I mentioned earlier, when you put money in an IRA or 401k, you become partners with the IRS and you have some choices for when they get paid. You can either let them call the shots, and then when you reach required minimum distribution age, which for most people it's in their 70s, depending on when you're born, the government starts to force that money out and tax it regardless if you need it to live on or not. Being preemptive and planning ahead with Roth conversions, like I mentioned, can be one strategy among a few others that you may want to consider when it comes to retirement planning. But understand this, not all investments are created equal. There are investments that produce interest, which is taxed at ordinary income, like bonds. That's less advantageous purely from a tax perspective than, say, stocks, for example, or real estate that you've held on to for more than a year. So something to consider. I put up a funny picture here. This is me and my family in the Dead Sea last year. We were visiting family there, and we were floating. The salinity of the Dead Sea, it's incredible if you've ever been. Hopefully one of these days you can enjoy it when there's more peace there. But for now, recognize that float is the term we use to describe having cash on hand readily available. High yield savings accounts, money markets, or short-term treasury debt can be a good option for you as you consider not only your emergency fund, but also short-term goals. For example, if I was saving for a home purchase in a year or two, like almost every American I know out there, they're all waiting to refinance, buy a home, or maybe move. A lot of retirees I work with are waiting to sell their homes until interest rates drop and they can get a more favorable rate. Well, in the meantime, should you just be saving for this big event in your life in a bank account, or maybe even in a savings or checking? I'm not sure you should. There's other options. We've described some short-term stuff, the float. There's also medium-term, which would be bonds, for example, or structuring a portfolio so that the risk was reduced, maybe not as aggressive as your long-term retirement stuff, but at least it's earning and growing something. And then the closer you get to that event, or in this example, buying a home, we start to tailor the risk back and get more conservative. Something to consider. Not all bonds are created equal when looking at that. We want to weigh the benefits of flexibility. That's a huge one. With a brokerage account, a lot of flexibility, but when you lock your money up in a 401k or IRA, that is, there's some restriction there. With a 401k or IRA, you're not able to get the money out before a certain age. 401k is 55, IRA is 59 and a half. And don't ask me why they're coming up with these half years. I don't know. They're your Congress coming up with these laws, but they got so many half years, it's ridiculous. But 59 and a half is a magical one for many retirement accounts. Well, what happens if you need the money before? There's some limited options there, and you could oftentimes get penalized with a 10% penalty on top of ordinary income tax that's assessed. And so maybe if you have these shorter term goals, a brokerage account might give you that more greater flexibility to come in and out. So if you're saving for a wedding, a home purchase, or some other event coming up in the short to medium term, maybe a brokerage account might be better suited for you. A question I get is on Roth contributions. Roth contributions that you make to a Roth IRA, for example, you can pull out the contributions whenever you want. It's the earnings, the growth, the interest that we have certain rules, 5-year rules, and these age requirements for. So something to think about there. We talked about my love for the HSA. Let's pause here. Michael, you got a question or two for us?